Welcome to Iraqi Dinar Update, your go-to source for the latest news, expert insights, and real-time developments on Iraq's currency, economy, and financial reforms. Whether you're a long-time investor or just curious about the dinar, you're in the right place. When discussing global monetary policy and the complex dynamics of currency valuation, it becomes essential to consider historical precedents and economic logic. Over the decades, countless countries have faced currency crises, inflationary spirals, and the arduous process of either devaluing or revaluing their national currencies. But what often gets misunderstood, especially among casual observers of the financial world, is how revaluation truly works, and under what conditions a currency might undergo significant appreciation, particularly without the removal of zeros from its nominal face value. To frame the discussion, imagine a hypothetical scenario in which a nation holds a currency that is trading at a fraction of a cent against the US dollar, say, $0.00076 per unit. Now, imagine that currency being revalued, and suddenly, it jumps to $3.22 USD. That's not just a mild appreciation. It's a monumental leap. In fact, this shift would represent a staggering increase of over 4,000%. The question then becomes, has this ever happened before in the history of modern economics? Has there ever been a case where a currency underwent such a dramatic revaluation in terms of percentage increase in its exchange rate, without going through a redenomination process that removes zeros? This is where the Iraqi dinar often enters speculative discussions. The Iraqi dinar, post-2003, became the subject of much attention, not only because of the country's geopolitical importance but because of the belief held by many investors and enthusiasts that one day, Iraq might revalue its currency dramatically, potentially restoring it to pre-Gulf War or pre-sanction levels. One of the most cited figures is the former rate of $3.22 USD per dinar, a level the currency traded near during the 1980s, when Iraq's economy, bolstered by oil revenues and a stable financial system, maintained a relatively strong exchange rate. But to jump from 0.00076 to 3.22 without a redenomination or removal of zeros is nearly unprecedented. Why? Because currency values are not just numbers, they reflect an intricate mesh of macroeconomic variables, including GDP output, inflation rates, fiscal policy, political stability, central bank reserves, interest rate parity, and most importantly, market confidence. When countries experience hyperinflation, they often deal with the aftermath by redenominating their currency, that is, lopping off zeros, to restore psychological and financial order. Think of Zimbabwe, Venezuela, or even post-World War II Germany. In each case, the currency was rendered practically useless due to inflation, and the only way forward was through currency reform and redenomination. Revaluation, in the truest sense, usually occurs under specific economic conditions: a strong trade surplus, growing foreign reserves, improved macroeconomic indicators, or a deliberate central bank policy shift from a pegged rate to a market-driven floating rate, often favoring appreciation due to investor confidence or monetary tightening. Even in such cases, the appreciation is gradual, seldom sudden, and almost never by thousands of percent. Some point to Iraq's natural resource wealth as a justification for a potential revaluation. After all, Iraq possesses the fifth largest proven oil reserves in the world and a significant endowment of strategic minerals. However, natural resources alone do not justify massive revaluations of currency. In the case of Iraq, while recent years have seen efforts to reform the banking sector, introduce digital payments, curb corruption, and establish a sovereign wealth framework, these efforts are still nascent. The Central Bank of Iraq has pursued a managed float policy and tightened controls on dollar transfers to comply with international anti-money laundering standards. These are all steps in the right direction. Still, such reforms take years to translate into meaningful economic indicators that can support an organically strong currency. Moreover, the revaluation speculation often ignores the difference between nominal and real value. If Iraq were to introduce a redenominated currency, say, removing 3 zeros from the current dinar, it could issue a new note where one new dinar equals 1,000 old dinars. This would not make citizens richer in real terms, but it would simplify accounting, increase confidence in the currency, and potentially stabilize inflationary expectations. It could be followed by a gradual appreciation of the new currency based on economic progress. But that's a very different path than simply waking up one day to a 4,000% surge in exchange rate without changing the numbers on the bills. The psychological aspect of currency reform cannot be overstated. When Turkey redenominated its lira in 2005, it removed 6 zeros from the old currency. 1 million old lira became 1 new Turkish lira. This wasn't a revaluation in the market exchange rate sense. It was a redenomination to restore confidence and reduce the chaos of hyperinflationary numbers. The same occurred in Brazil, Russia, and Argentina over the decades. These moves were done not to create sudden wealth, but to create a usable, rational monetary system again. This is where many misunderstandings arise in conversations about the Iraqi dinar. Many speculate that because Iraq once had a strong exchange rate, it can and should return to that level. But exchange rates are not about history, they are about present realities and future expectations. Iraq in the 1980s had a controlled economy, limited imports, centralized foreign reserves, and relatively stable governance under a dictatorship. The exchange rate of $3.22 was artificially pegged and not reflective of open market value. Today, Iraq is attempting to become a market-based economy, reintegrated into global financial systems and regulated by international standards. The path to currency appreciation will not be based on reverting to an old number. It will depend on achieving the economic fundamentals that justify a stronger value. Additionally, no reputable economic model predicts such a dramatic rise in value without either 1. A redenomination or 2. A multi-decade process of strong real GDP growth, trade surplus accumulation, capital inflows, and rising investor confidence. Even then, 4,000% would be extremely rare. In closing, while it's understandable that dinar holders would hope for a sharp revaluation to a historically high exchange rate, history and economics suggest that this scenario would be unprecedented. No country has ever revalued its currency by 4,000% without redenomination, and certainly not in a short span of time. Reforms, improvements, and modernization are underway in Iraq, but they support the likelihood of a gradual path forward, one rooted in macroeconomic stability and institutional development, not a sudden overnight transformation. Understanding this distinction is key for anyone seriously following Iraq's financial trajectory or investing in its currency. Thanks for tuning into Iraqi Dinar Update. If you found this content helpful, be sure to like, subscribe, and hit the notification bell so you never miss a beat on Iraq's evolving financial landscape. Stay informed and stay ready.